Hello, Baker investment students. I hope everyone had a good week and good weekend. It is Sunday, November 6th, and we are now into week 2. So hopefully the Chiefs can get a win this weekend and add dividends to their portfolio. So we'll see. So first for this week, just a little bit of reminders. You're going to do like a rinse and repeat with the forum discussion. I'm interested to see how you do this week. And I posted mine out there as an example, and I'll jump in this morning to see what other people have posted. And I'll try to reach out to each of you because at least, with the class of 6, I should be able to get to everybody each week. But if I don't, just know that I might rotate weeks, but should at least give some type of response. So, and you'll have your homework for week 1. It's just a week lag, so just make sure to get that in. I'll grade it at the same time. But other than that, for this coming week, think about, you're going to look at 2 more chapters, chapter 3 and chapter 4. Chapter 3 kind of looks at a lot of like, how do we gather information about markets and financial investments? It's going to start off first with a philosophy I follow is you look at, see how the economy is doing. Right now, the economy was growing at a 2.2% GDP annual rate. Jerome Powell is really trying to slow the economy down right now at the Federal Reserve by raising interest rates because inflation is way out of control. And that's not a good thing for anybody. It has wealth effects. So even if you hear Elizabeth Warren and other politicians shouting out that they're killing jobs, trust me, you want to make sure inflation is under control because it can really eat away on any of your investment returns. It's something we have to think about when we're investing. So. But then you get to specific to the industry. How is that particular industry doing? Some industries do better when the economy is not doing as well. We saw right now, big oil, that's been attacked recently too. And even Larry Sumner's a former economist for the Democratic administration said, be careful, Biden, don't go out and attack big oil too much right now because they lost a lot of money in previous terms. So it's really based on a world price. So politicians say very interesting things, whether it deals with fiscal policy or how the economy is working. And a lot of times they really don't understand or never took an economics class. So you have to be really careful, especially who you're voting for in these midterm elections here. And then you get to company specific. That's where we do kind of the nitty gritty of this class. You look at the management, you look at their potential for profit. Does this look like it's something viable for a long term, or is it just something short you want to try to get out quickly? But companies, you can gather a lot of news about company and information today with the internet, which we didn't have, say 30 plus years ago. That's why I truly believe that you don't need to pay somebody to invest your money. Why give them $1,000 every year when you have all this information available? And if you believe in efficient market hypothesis, which I do, that you can probably do just as good or better than hiring some professional doing this. Of course, you want to talking strategy where you are in your life, but I'm never a big fan of just giving money to someone, which I think you can duplicate on your own because there's so much information and advice out there today, and that you're taking a course like this to get better at this too. So, but there's different websites like CNN Money. Obviously, there's you could go to a brokerage for information, but I say you go to this usually because a lot of you probably have 401ks from work, and a lot of times through those 401ks. They can provide investment research about different companies. But again, if you believe in efficient market hypothesis, a lot of that news is dated. It's really more about what are the objectives for the long run if I'm going to invest in different types of securities. You can look at how the Dow Jones Industrial is calculated. The Dow Jones, it was started from the many years ago in the 1800s. There was actually 3 guys, and they could only fit Dow and Jones on the marquee, if you will. So the other guy got lost in history. But it's just that you're taking an average of 30 stocks, the prices, and you divide by a divisor. The thing with the divisor is it's constantly changing because stocks have split over the year. Now the S&P index, the S&P 500 index starts at a base year, and you look at that price in the base year, that all those stocks, and how has it changed each successive year. So the S&P 500 index has been down well over 20% for the year. We saw a little bit of a bump on Friday, but I think still overall stocks are down for the week. But big question now is, should you be buying now? Because we hit rock bottom, and then perhaps the markets will start to come back if we get inflation under control and the economy is continually do well. But you'll look at different types of brokerage firms you could use. A full brokerage firm they're going to pay a premium dollar for. Maybe if you're a doctor and an attorney and have lots of money, you just want somebody to invest your money for you, that would be like a Merrill Lynch. Someone like me, I use a mid-level like a Fidelity, and I manage money within my own personal traditional IRA. I have some of my other 401ks from other places that I've taught. When they offered me a 401k that just kind of is connected to Fidelity too. And then you have the discount, which is the very low dollar but almost no advice, like a Robinhood or something like that. So with the types of orders in the markets, you can have what's called a market order limit that says, hey, I want you to buy at a specific price. You wait until it hits that price. Or you can also have a stop loss or stop order. Let's say the stock price, if Amazon falls down to below a certain threshold, you're going to say, hey, I want to get out and I want to sell that. So that's pretty much with Chapter 3. With Chapter 4, you're going to look at risk and return. Some of this should be familiar if you've taken a finance class before. But specifically with investments, there's two ways you can make money. One is through the income, interest or dividends, and the other one is the capital gain. And the capital gain is what we hear most about in the news, about stock prices changing. But if you look at historical performance of the S&P 500, if you were ever to go to like Money Chimp and look at that, still the S&P over a long period of time has an average return about 10%. Now that doesn't mean that every year is 10%. Obviously, we've seen that. This past year, it's been down like 25% at one point. So very much, a bear market. But again, there's a wide range of returns through those periods, so there's a greater standard deviation. But if you're investing for the long run, this is why I say, again, for efficient market hypothesis, most professional money managers have a hard time just beating the S&P 500. So if you were to do anything, you just pick a S&P 500 index fund and write it out for a very long period of time, but you can adjust your portfolio at different periods of your life, that I'm less in stocks and more to other conservative types of investments. So you're going to go through the concept of present value on page 130, 131. This is a good review. And you're going to go through this concept, of what constitutes a return. Obviously, there's some risk-free rate, like U.S. Treasuries and notes and bonds considered like the risk-free rate. There's an inflation premium, which, investors' expectation of inflation is really high. Now, that doesn't necessarily translate, even if we have 8.2% inflation at annual rate right now, that you're going to be compensated for that, because there's a lot of other market factors with supply and demand. But it is something you have to think about, because it's eroding away your purchasing power. If you stick to, say, just a basic savings account, you're going to be much worse off. And that's a concern right now for a lot of investors and a lot of individuals in the United States. I did see that the Treasury is offering a one-time I-bond, almost 10%. That offer is gone. I think now the best you can get is like a 6 or 7 through those I-bonds. But you had to lock your money up for a period of time. It was only limited like $10,000. I think $5,000 if you had a refund that was large enough that you could buy one through that. But then you get some type of premium for whatever risk you're taking on. And that's a lot of what the rest of this chapter is talking about, is the risk associated with it. You have business specific risk. You could have economic risk. You could have liquidity risk. You need to be able to get your money back. Tax risk and event risk is the big one, especially what we saw with COVID, where our economy just plummeted. A lot of people were unemployed, and then we had a big swing back. So if you were able to invest kind of the downturn in the market with COVID, you could have made a lot of money. But it's hard to predict these things and when they're going to change. So anyway, lastly, just kind of wrap up with the concept of risk with give you 2 examples of standard deviation. I'm a big fan of, I grew up in the 80s playing video games. So when I think of standard deviation, what you're doing is you're taking differences from some mean, you're squaring all those differences, And then I like to think of like Pac-Man, waka, 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 waka. That's your square root sign. And here's your variance, and the variance is just those square differences. So once you do this, that's when you get standard deviation, because you have to reverse out. You squared everything, and a square root reverses that out to give you a number that's understandable. And obviously, the standard deviation tells you about that spread. And obviously, the greater the standard deviation, the greater the risk. So they gave one with an American Eagle, and the other one, I believe, was something to do with Target. And Target had less of a standard deviation. But bottom line, it's about your willingness to take on risk. I would say most of us tend to be risk adverse, including me, to a degree. We're not going to go out and just dump, $1,000 on the Powerball this week and then try to provide an explanation to someone that we don't have enough money to pay the mortgage payment or the car payment. So we're going to take calculated risks, but there are definitely differences in individuals about how much risk they're willing to take on for a potential return. And the question is, are you going to be okay with that mentally if you're taking on a lot of risk and you're losing a lot of things? Like I went to the Fed conference in St. Louis this week, and they were really just talking about Bitcoin and all these other investments that at least the guy that presenting at the Fed says it's still high risk. If you don't know what you're investing in, you probably shouldn't be investing. And a lot of this, there was a craze with Bitcoin and other types of currencies out there. But was interesting, even from systemic risk, there was a big failure with one of these digital currencies, and it didn't have systemic risk. So there are people out there willing to gamble, and if you are a gambler and things like that, and you can afford these losses, good for you. But I can't do that. I want to keep improving my standard of living over a lifetime. So. All right, if you have any questions, do email me, but otherwise have a great week, and I'll look for any of your questions you may have via email, checking the forum discussion. Again, if you want to post like on Thursday, if you want to have the end of the week, say, hey, I just want to track at the end of Thursday on the stocks, I'm totally fine with that. Get the forum post in there early. I'll leave that up to you. But do try to jump in by Saturday, get that initial post in so that people have time to respond. So have a great week, and we'll talk to you online.